We've laid a solid foundation to begin building your option strategies upon. So far, we've utilized technical and fundamental analysis. Now let's introduce spreads and combinations into the mix. Since I'm an eternal bull, it only makes sense to begin with a bullish option strategy. In this section, you will learn how to adapt the vertical bull call debit spread to your hypothesis and assess the outcome of applying this spread to your strategy. So let's go ahead and look at this bullish setup. So your hypothesis needs to be that you expect the stock to outperform in the future versus the market. So remember, the market is actually really important as determining the direction of a stock. But the bottom line here is you expect there's going to be an upside positive catalyst for the stock in the future. That is when you're going to put on a trade setup like this. Let's go ahead and talk about the definition. So this trade setup is actually referred to commonly as a bull call spread. It's just easier to say. Bull is referencing bullish for the stock, so you need the stock to actually go up. Now, how do you structure this trade? You're going to buy one call while simultaneously selling one call, same expiration, but of a higher strike. There's also a trade-off here. You're going to reduce the premium spent while also capping your potential profit. So let's go ahead and look at a P&L graph of a bull call spread. So here is our trusty graph here. On the x-axis, we're going from 0 to infinity here. That's the stock price. So as we move along the x-axis, the stock price is increasing, decreasing this way. Also, you have your P&L here on the y-axis. Above 0, positive P&L. Below 0, negative P&L. There's three things that you want to focus on and understand about a bull call spread. One is, let's go ahead and talk about our losses. So our losses are capped. So that's this horizontal line. So as the stock moves further to the left, as it's going lower, those losses hit a max rate. And so as you hit this horizontal line, you can't lose any more money. So in this example, $200 is the most that you could potentially lose. And that's attractive for a bull call spread. Also, this horizontal line is telling you that there's a max profit that you can make. So in this example, it's $300. Even if the stock goes to $60, doesn't matter. The max that you can make in this example is $300. You also need to concern yourself with that break-even point, which happens right here, and in this example, it's 42. So let's go ahead and start to look at the formulas that you need to be aware of for a bull call spread. First thing, always figure out your loss. Your max loss is simply the net premium spent times 100. And obviously, it's times the number of contracts. So in our example, it's going to be one contract. So if you spend $200, that is all that you can lose. It's the net premium that you spent. Max upside profit potential. Remember, we went over this earlier whenever we discussed spreads and those formulas, a debit spread. Well, it's simply going to be the call spread width minus the premium spent. We're talking about one contract here times 100. So again, that's going to be your max upside profit potential. Break even is very simple. You need to know your lower strike, and then you're going to add that net premium spent. So remember, you're spending money on this spread, so you have to make above and beyond that premium that you're spending before you can actually make money at expiration.